If you turn on social media right now, real estate looks incredibly easy. Buy a house, paint the walls, put a tenant inside, and collect thousands of dollars a month in passive income while sitting on a beach. But here is the truth that 60-second videos will never tell you. 90% of people who try to start a real estate business fail within their first 2 years. They fail because they treat real estate like a casino instead of a business. Real estate is not a get-rich-quick scheme. It is a high-stakes, capital-intensive, problem-solving enterprise. Whether you have $100,000 sitting in the bank right now, or you are starting with $0 and bad credit, this script is your complete step-by-step masterclass. Today, we are going to walk through the exact blueprint to take you from a total beginner to running a profitable, scalable real estate enterprise. Before you look at a single property online, you need to answer one fundamental question. What business model are you actually going to run? Real estate is not a one-size-fits-all venture. Depending on your current savings, your available time, and your risk tolerance, you must select the right vehicle. If you pick the wrong vehicle for your current situation, you will run out of money before you ever close a deal. There are 5 main strategies for beginners. The first strategy is wholesaling. Wholesaling is essentially real estate matchmaking. You find a beat-up property owned by a motivated seller, put it on their contract at a deep discount, and then assign that contract to a cash buyer for a finder's fee, usually $5,000 to $20,000. The best part about wholesaling is that it requires almost zero capital or credit. The downside is that it takes high daily effort, constant marketing, and your income is entirely active. When you stop hunting deals, you stop getting paid. The second strategy is house hacking. This is hands down the best move if you have a small savings account. You buy a 2 to 4 unit building like a duplex or triplex using a low down payment residential loan, often just 3.5% down. You live in one unit and rent out the others. Your tenants pay your mortgage every month while you live for free and build equity. The downside is that you live next door to your tenants, so you have to set clear professional boundaries early on. The third strategy is fixing and flipping. You buy a distressed property, hire contractors to renovate it, and sell it on the open market for a lump sum profit. Flipping offers huge paydays, often $30,000 to $100,000 per deal. However, it carries higher risk, requires managing contractors, and makes you vulnerable if the market turns during your renovation. The fourth strategy is the BRRRR strategy, which stands for buy, rehab, rent, refinance, and repeat. You buy a beat-up property with short-term money, renovate it, place a qualified tenant, and then go to a bank to get a long-term mortgage based on the new higher value of the home. You pull your original investment back out tax-free and go buy the next property. This allows you to scale a rental portfolio rapidly with the same pool of capital. The fifth strategy is traditional buy and hold. You buy a property in good condition, place a long-term tenant, and collect steady monthly cash flow while enjoying appreciation and tax write-offs over time. This is very passive, but it requires substantial down payment cash up front, usually 20 to 25%. Pick one strategy today based on your current budget. If you have less than $10,000, start with wholesaling or house hacking. If you have capital and time, look at flipping or the BRRRR strategy. Master one single strategy before trying to diversify into others. In real estate, numbers do not lie, but people do. If you buy a property based on emotion or hope, you will go broke. To run a real business, you must master basic deal analysis. The first rule you must learn is the 70% rule. This rule tells you the maximum price you can offer on a home that needs work. You take the after repair value, which is what the property will be worth on the market once it is completely renovated, and multiply it by 70%. Then you subtract your estimated repair costs. That calculation gives you your maximum allowable offer. For example, if a house will be worth $300,000 fully fixed up and it needs $50,000 in repairs, you take $300,000, multiply by 70% to get $210,000, and subtract $50,000 for repairs. Your maximum offer is $160,000. If you pay a single dollar more, you are destroying your safety buffer.
The second formula is net operating income. This measures the annual profitability of an income property before paying your mortgage. Take your total annual rent collected and subtract all operating expenses, including property management fees, property taxes, insurance, routine repairs, and vacancy reserves. What is left over is your net operating income.
The third formula is capitalization rate, or cap rate. This measures the unleveraged rate of return a property generates if you paid all cash. You divide the annual net operating income by the total purchase price. If a property generates $24,000 in net operating income and costs $300,000 to buy, $24,000 divided by $300,000 gives you an 8% cap rate. Higher cap rates mean higher immediate income, but usually come with higher risk neighborhoods. Lower cap rates mean prime real estate with lower cash yields. The fourth formula is cash-on-cash return. This measures the exact percentage return on the physical cash you pulled out of your wallet. Divide your annual net cash flow after paying the mortgage by the total cash you invested out of pocket for the down payment and closing costs. If you put down $40,000 out of pocket and walk away with $4,000 in profit at the end of the year, your cash-on-cash return is 10%. Aim for a minimum of 10 to 12% on rental properties to ensure you have a safe buffer for unexpected emergencies. Location dictates your long-term success, but analyzing a market as a business owner means looking at data rather than personal convenience. You do not buy in your backyard simply because it is close. You buy where economic metrics support your strategy. To find a profitable market, look at three major drivers. First, examine job growth and economic diversity. Look for cities where job growth is consistently higher than the national average. Avoid single industry towns where the entire economy depends on a single factory or military base. If that single employer shuts down, your rental market collapses overnight. Seek markets with healthcare, technology, higher education, and manufacturing all working together. Second, check population growth. People follow opportunity. Look for metro areas with consistent population growth of at least 1% annually over the last 5 years using public census data. Third, look at the price-to-rent ratio. Take the median home price in an area and divide it by the median annual rent. If a home costs $200,000 and rents for $20,000 a year, your ratio is 10. Ratios between 10 and 15 represent the sweet spot for cash flow real estate. If the ratio goes above 20, property prices are too high relative to rents, meaning you will struggle to generate positive monthly cash flow. Once you pick a metropolitan area, narrow your focus down to 3 to 5 specific zip codes. Become a hyper-local expert in those neighborhoods. Know what a 3-bedroom, 2-bathroom house rents for down to the exact dollar before you ever make an offer. Now we arrive at the engine of your business, deal flow. If you rely on browsing public real estate listing websites like a normal home buyer, you will compete with hundreds of buyers and overpay every time. A real estate business sources discounted properties directly from owners before those properties ever hit the open market. You need a marketing system that brings motivated sellers to you. A motivated seller is someone who values a fast, convenient, certainty-filled sale over getting top-dollar retail price. The first lead channel is driving for dollars. This costs very little money, only your time. Drive through your target zip codes looking for physical signs of neglect: overgrown grass, boarded windows, peeling paint, or overflowing mailboxes. Note the address. Use a skip tracing tool to find the owner's phone number and call them directly. Ask them if they have ever considered taking a cash offer on their property in as-is condition. The second lead channel is direct mail marketing. You can pull public data lists of high-equity absentee owners, people who own a house with deep equity but live in another city, or probate lists of heirs who just inherited a property they do not want to manage. Send clean, simple letters or postcards consistently. Direct mail works through repetition, so plan to reach out multiple times. The third lead channel is building relationships with investor-friendly real estate agents. Reach out to agents who list beat-up properties as, say, cash buyers only. Tell them that you buy multiple properties a month for cash, and if they bring you off-market deals or deals where the buyer's contract fell through, you will allow them to represent you so they earn both sides of the commission. The fourth lead channel is direct cold calling. Gather lists of distressed property owners and reach out over the phone systematically to ask if they are open to an offer. Real estate is a pure volume game. You will typically need to contact 100 potential leads to get 10 good conversations, to make 5 offers, to get 1 deal accepted under contract. If you are not making offers every week, you do not have a business, you have a hobby. Sourcing the lead is only half the battle. You must convert that lead into a signed contract. Beginners often make the mistake of acting like aggressive salespeople, boasting about cash and fast closings. Motivated sellers do not care about your cash. They care about their specific problems. Your role is not to sell real estate. It is to solve human problems. Follow a simple 3-step negotiation framework. Step 1 is finding the core motivation. Never talk about price early in the conversation. Build genuine rapport and ask open-ended questions. Ask them why they're considering selling right now and what their alternative plan is if they decide not to sell. Listen 80% of the time and speak 20% of the time. Step 2 is letting the seller establish the property's defects. Walk through the home with them and let them point out what is broken. Ask open questions about the age of the roof, the condition of the HVAC system, or past plumbing issues. When sellers state the defects themselves, they naturally lower their price expectations. Step 3 is presenting options through contrast. Do not blurt out a low offer without context. Frame your cash offer alongside the hard alternative. Tell the seller that they have 2 paths. Option A is spending tens of thousands of dollars fixing up the house, hiring an agent, paying 6% commissions, waiting 6 months and dealing with dozens of home inspections. Option B is taking your cash offer as is, leaving whatever unwanted junk or trash behind, paying 0 closing costs and having money in their bank account within 2 weeks. Then stay completely silent. The first person who speaks after an offer is presented loses leverage. Let the silence sit until the seller responds. The biggest misconception holding beginners back is the belief that they need hundreds of thousands of dollars in personal savings to buy real estate. Conventional bank loans are only one way to purchase properties. In real estate, if you find a deeply discounted deal, the capital will follow you. There are 4 primary ways to fund deals using creative capital. First are hard money lenders. Hard money lenders are private companies that lend money based primarily on the asset rather than your personal credit score or job history. They will fund up to 90% of the purchase price and 100% of the repair costs. They charge higher interest rates, typically 9 to 12%, because they provide rapid, short-term debt meant for flipping or renovating. Second are private money lenders. These are individuals in your network, business owners, doctors, family friends, or retirees who have capital sitting in low-yield savings or retirement accounts. You pitch them a predictable fixed rate of return, like 8 or 10%, secured by a mortgage or deed of trust on the real estate. They get reliable passive income and you get flexible capital without bank approvals. Third is seller financing. Instead of going to a bank, the seller acts as the lender. You make monthly mortgage payments directly to the property owner over an agreed time frame until the agreed purchase price is paid off. Sellers often accept this because it gives them steady monthly income while saving them from paying massive upfront capital gains taxes. Fourth are equity partnerships. If you find a great deal but have 0 capital, partner with an investor who has cash. You contribute the work of finding the deal, negotiating, and managing contractors. They provide the down payment and loan qualification. You split the profits 50-50. Half of a great deal is infinitely better than 100% of a deal that never happens. Finding and funding the deal makes you an investor, but managing execution makes you a business owner. Without solid systems, your enterprise will quickly turn into a chaotic job. You must build your core 4 team before taking on your first major project: an investor-friendly real estate agent who understands local valuation, a general contractor to estimate and execute repairs, a creative mortgage lender to structure your debt, and a real estate attorney or CPA to manage contracts and taxes. When managing contractors, strictly follow 3 golden rules. Rule 1. Never pay 100% of the money up front under any circumstances. Rule 2. Require a detailed scope of work. Write down every single light fixture, flooring choice, paint color, and repair item line by line with itemized pricing before signing any agreement. Rule 3. Establish a strict payment draw schedule tied to completed work. Pay a small deposit to start, followed by installment payments only after specific milestones pass inspection, such as completion of rough plumbing, drywall, or final trim. Keep a final 10% holdback until the entire job is walked, inspected, and approved.
Once you complete your first few deals, you shift into scaling phase. This is where you transition from making active income to building wealth that lasts. To scale effectively, leverage three powerful tools. First are tax advantages. Real estate offers unmatched tax benefits. Use depreciation to write off the physical structure of your investment property over time as a paper loss, offsetting your rental income tax obligations. When selling an investment property for a large profit, use a 1031 exchange. This tax provision allows you to roll 100% of your capital gains directly into a larger like-kind property without paying immediate income taxes on the gain. You defer taxes, buy larger properties, and compound your wealth exponentially.
Second is portfolio refinancing. As you fix up properties and increase their market value, perform cash-out refinances to extract your initial capital tax-free. Reinvest that recycled capital into buying additional cash-flowing properties without constantly pulling money from your personal income. Third is moving up asset classes. Single-family homes are great for mastering fundamentals, but scaling unit count becomes far more efficient with multifamily properties, such as 5 to 50-unit apartment complexes. Managing 20 units under a single roof with one lawn, one roof, and centralized operations is significantly more efficient than managing 20 separate single-family houses spread across town. Furthermore, commercial multifamily properties are valued based directly on their net operating income. By increasing rent or reducing operating costs across an apartment building, you systematically increase the forced equity value of the asset. Knowledge without execution is completely useless. You now understand how to select your strategy, run the math, pick your target zip codes, source off-market leads, negotiate with sellers, raise creative capital, manage contractors, and scale a portfolio. Here is your 90-day execution roadmap. During days 1 through 30, pick your single business model, choose your target market, identify 3 core zip codes, and recruit your core 4 team members. During days 31 through 60, set up your lead tracking systems, start driving for dollars or sending direct mail, and analyze 5 property deals every day to train your deal analysis skill. During days 61 through 90, make a minimum of 5 written offers every week. Follow up relentlessly with every lead. Secure your financing and close your first real estate deal. Stop waiting for the perfect moment or perfect market conditions. Successful real estate business owners do not wait until they know everything. They take disciplined action and adapt along the way. Take the first step today and begin building your business.